Most retirement income plans fail for one of two reasons. They're either so complicated that you can't follow them, or they're so simple that they don't account for real changes. The good news is there's a better way. It's called the three-bucket strategy, and it's a framework that we use to structure retirement income for clients who simply want simplicity without sacrificing effectiveness. In this video, I'm going to walk you through exactly how this strategy works and show you a real million-dollar example with specific calculations. By the end, you'll understand not just what the three buckets are, but how they work together to give you an income you can count on without losing sleep over market crashes. Chapter 1. Why most retirement income plans fail. Roughly 1 in 3 middle-income retirees depletes their financial assets within about 20 years of retirement. That doesn't mean they have zero income. Most still have Social Security, but it means their savings is gone. Here's what typically happens. People retire with a portfolio and know they need to take money out each month, but they don't have a clear system for which accounts to tap, how much to keep liquid, or how to protect themselves when the market drops 20 or 30%. So they either play it too safe, keeping everything in cash while inflation erodes their purchasing power, or they stay too aggressive and end up selling stocks at the worst possible time just to pay the bills. The single biggest risk to your retirement isn't picking the wrong stocks or paying too much in fees, it's sequence of returns risk. This is what happens when you need to withdraw money while the stock market is down significantly. You're forced to sell more shares to get the same dollars, and those shares can never recover for you. God forbid somebody retired in 2007 and was pulling from their portfolio in 08, 09, or 2010. That person wasn't thinking about long-term returns. They were wondering about, am I going to have to go back to work? The three-bucket strategy eliminates that risk. Chapter 2. Bucket 1, cash. Let's start with the foundation. Bucket 1. This is your cash reserve for short-term emergencies. I want 6 to 12 months of living expenses sitting in high-yield savings accounts or money market funds. Let's say your monthly expenses are $8,000 or $96,000 a year. For bucket 1, you'd want between $48,000 and $96,000 in cash. This means you are liquid and covered when life happens. Car breaks down, need a new roof, medical expenses pop up. Bucket 1 handles those surprises so you never have to touch your other buckets at the wrong time. This isn't the money you live on day to day, that comes from bucket 2. This is strictly your emergency cushion. Chapter 3. Bucket 2. Protected income. Now we get to bucket 2, which is really the workhorse of the entire strategy. This bucket funds your lifestyle for the next 20 years without exposing you to stock market risk. 20 years of income with no market risk. You can structure this with tools like money market accounts, CDs, or fixed indexed annuities. It just has to be something we know is not going to lose money. Most of our clients choose a fixed indexed annuity for this bucket after we walk through the options. Here's why. A fixed indexed annuity has limitations, but it gives us a floor at 0. We can't lose money to market downturns. Typically averages between 5 and 7% a year, and in good years it can capture up to 10 or 11% depending on the cap. Compare that to bonds, which have averaged really over 1 to 2% a year over the last decade while you're still paying fees on that money. Now let's look at an example. Say you're 65, retired, and you need $50,000 per year from your portfolio. You've got $1 million saved. Here's how we might structure it. Bucket 1 gets about $80,000 for emergencies. Bucket 2, $650,000 to fund our protected income. Bucket 3 gets the remaining $270,000 for long-term growth. We calculate exactly how much we need to give you $50,000 a year adjusted for inflation so that in year 2, you're getting $51,500, in year 3, $53,000, and so on. By the end of that 20-year period, bucket 2 can be down to 0. That's totally fine. It did its job. Its job was to fund our income for 20 years, while bucket 3 can grow enough to start the whole process over again. And if the S&P 500 drops 40% tomorrow, bucket 2 doesn't care. It's insulated. Chapter 4, bucket 3, long-term growth. Now let's talk about bucket 3, your growth bucket, the money you don't touch for 20 years. That time horizon is critical because it allows this bucket to be invested aggressively without you losing sleep over volatility. Here's the fact that makes this work. We've never seen a 20-year cycle in the stock market that's lost money. Not once. That's why we structure bucket 2 to cover 20 years. So bucket 3 has the time it needs to grow. In our example, you have $270,000 in bucket 3. That money goes into a portfolio of equities. Because buckets 1 and 2 have to be covered for 20 years, you can let bucket 3 do its job without worrying. The S&P 500 drops 25%. You don't care. You're not touching that money for 2 decades. Over a 20-year period, the stock market has historically averaged around 8% annually. At 8%, money doubles roughly every 9 years. The exact ending value depends on your specific income needs and how much goes into each bucket. But here's what happened. You started with $1 million. You got all the income you needed over 20 years. You gave yourself a raise every year to make sure you kept up with inflation. And at the end, you have as much or likely more than you started with. That's a win. Simple approach, but it works. Chapter 5. Stated simply, the 3-bucket strategy is designed to work without constant adjustment. Bucket 1 turns most emergencies into annoyances. Bucket 2 is structured from day 1 to provide your income for 20 years with inflation already built in. And bucket 3 grows untouched so it can fund your next 20 years. That said, life changes. We check in regularly to make sure that the plan still fits your situation. There may be major changes in tax laws, creating opportunities or needs to work with our CPA network. Healthcare needs can change, and the industry itself may have a shakeup that we need to navigate. But the goal of the bucket system is to provide us with the flexibility we need without overthinking. Retirement income planning doesn't have to be overwhelming. The 3-bucket strategy gives you a simple framework for turning your savings into a reliable income without constantly worrying about market crashes. To see if this approach might be a good fit for your situation, schedule a call with our team through the link in the description.